Hello everyone. Today we are going to discuss national income accounting, basic concepts and related aggregates. First of all, we will discuss learning objectives. After finishing this topic, students will be able to understand the different concepts related to the national income. They also will be able to understand relation between the different concepts. Student will be able to recognize the different type production activity which will include in national income and which will not include in the national income. And they also able to differentiate between the value which will be included in national income, which will not be included in national income, and also the different type of activity. And then they also able to know how to calculate the national income by the different methods. Like we have three method: income method, expenditure method, and product method, or maybe it is also called evaluated methods. So after finishing these concepts, they will be able to know how to calculate the national income by different methods. So first of all, in this session, we will discuss the basic concepts related aggregates. In the next session, we will discuss methods, different methods. First of all, the classification of goods. The first goods, the final goods. The final goods are those goods which are ready for sale in the market. It means that not used as a raw material to produce other goods. It is only already finished and it is final and which is ready for the consumers. It means they can directly use. It means there is no further value added in this type of product. That is called a final product, a final goods. And against of this, the intermediate goods. These goods are not ready for sale in the market, and these goods are used as a raw material to produce other goods. It means value yet to be added in this type of goods. Like final goods like shoes and clothes, which is already prepared and which is already ready for the consumers. But intermediate goods like as a leather, cotton, etc. From the leather, we prepare a shoes, and then from cotton, the prepare a cloth. So in this way, the intermediate goods which is not ready for sale in the market, but final goods are ready for sale in the markets. One important thing is here the one goods, maybe it is final intermediate, depend on the use. Sometime it may be final goods or sometime may be intermediate goods. Like as bread used by the baker to prepare toaster or cake. Okay, then that is the intermediate goods. But if it is same bread is consumed by the household, then it is a final goods. One bread which is used by the baker to prepare toast and cake, because they add some values in that, so that's why that is intermediate goods for them. But if it is used by the household, then it is a final goods. It means it depends on the use. If it is used by the another persons for to resales, or maybe it is finally consumed, so it depends on the use. On the basis of use, we can decide it is a final goods or a intermediate goods. Now the difference between final and intermediate goods, sometime in the exam they can ask you what is the difference between final goods and intermediate goods. On the basis of that, these goods not used as a raw material to produce other goods. Final goods that already we have discussed is not used as a raw material to produce other goods. It is used finally. But intermediate goods are used as a raw material to produce the other goods. These have completed the production process. It means it is complete all the production process. It means there is a no left out production process. But these have not completed the production process. It is under the boundary line only, but it is complete the boundary and cross the boundary line. These are ready for sale in the market. The final goods that already I told you, it is ready for sale in the market. It means it is a complete all the process, so it is ready for the consumption or sale in the market. But these are not ready for the sale in the market. So these are included in the estimation of national income because it is final goods. So it will be value of these goods included in the national income, but the intermediate goods value will not be included in the national income. These goods cannot be resold in the market. It means it is finally used or finally consumed, so it cannot be resold, but it can be resold in the markets. Means it is not cross the boundary line like as a bread. Bread if is used by the toast makers or the bakers, then it is a intermediate good. So it means it can be resource in the market. Value is not to be added in these goods. Final goods, that value is already added, so it's not to be add these goods. But here value is yet to be added in these goods. Like shoes and clothes is a final goods, and but leather and cotton is a intermediate goods. So these are the basic difference between the final goods and intermediate goods. Now another type of goods is their consumption goods, which are used directly or which are satisfy the human wants and not used for production of other goods is called a consumer goods or consumption goods, which is directly consumed by the consumers, which is directly satisfy the human wants, directly satisfied the consumer is called a consumption goods. It means it is not used for the production of the another goods like clothes, uh, food, etc., milk. These are type of goods, consumption goods, because directly satisfy the human wants, because it is not used by uh, the persons to for other production for further production. It is used by the households, so that's the consumption goods. Type of consumption goods we can divide many parts, like durable goods, which are used for the several years and of high of value, like TV, car, refrigerator, AC. It means it is used for the long period. That is called a durable goods. Semi-durable goods, which are used for about period of 1 year, like clothes, crockery, etc. It means it is not used long period, but it is used for 1 year or maybe 2 year. Then non-durable goods, which are for single time use, like as a bread, fruit, milk, petrol, etc. That is also called a perishable goods, which is one time use. That is called perishable goods. Service and non-material thing, which directly satisfy human needs, like as a service of doctor, lawyer, teacher, servant, etc. This type of is called as services, not goods. Okay. Then the another type of goods is the capital goods, which are used for the further production, which is used for the production process for several year and high value, like plant and machinery. These type of goods is called a capital goods. Capital goods means which used for the production process. Okay. Now producer goods. All those goods which are used in production process, that is called a producer goods. Like as a this type of goods include the raw material, example goods to make furniture, and capital goods, example plant and machinery. Maybe all the producers goods, maybe some goods may be the capital and some may be not a capital goods, but producer goods are those which used for the production process, like as a raw material, and maybe and then the like as a wood to make furniture, and the capital goods like plant and machinery. And the second basic concept is investment or a capital formation. Uh, Investment or capital formation, maybe it is the process of addition in the stock of capital or a production capability, like the construction of the new factories, machinery, transportation facility, etc. I means investment is equal to the change in the capitals. Means if we add something in the capital, that is a part of capital formation, or maybe another word we can say it is a process of addition in the stock of capital. Delta show the change in key capitals. So it is addition in the capital as a investment or in capital formations. Now investment we divide in two parts: induced investment and then the autonomous investment. Induced investment, which depend on profit or output, is called induced investment. Maybe induced investment are those which is depend on the profit or output. When profit increase, it increase; when profit decrease, it may be decrease. But autonomous investment, which is not depend on the profit, is called a autonomous investment. It is fixed investment. It means it is one time investment. If you invest, then it is not increase when the profit increase, maybe in the mostly in the short periods. Maybe long period it can be increase, but in short period it will not be increased. So it is a autonomous investment because it is not depend on the profit or output. But induced investment which depend on the profit or output. When profit increase, then it increase. The autonomous curve is parallel to the OX axis, and the induced investment curve is parallel to the 45-degree angle. Means profit increase, then the uh, uh, investment also increase. Then gross investment, the total capital formation in a given period in an economy is termed as a gross investment. Gross investment means total capital formation in an economy. It means that new expenditure on the capital goods and the expenditure on the replacement of the um, capitals. So that is called a gross investment. I mean the total investment in an economy is called a gross investment, in which we will include the new investment and the expenditure on the repair or maybe etc. So the total is called a gross investment. Gross investment we can show it with the help of formulas. Gross fixed capital formation plus change in stock. Maybe any addition in the stock or gross fixed capital during that particular period is called a gross investment. The net investment means net addition to the stock of capital, in which we will include only the new investment, not on the old investment or repair. It means if we want to calculate net investment from the gross investments, then minus depreciation we will reduce. Gross investment minus depreciation is a net investment. Net investment is only the net addition to the stock of capital, but gross investment means fixed capital formation plus change in a stock. So net is a net because in which depreciation is not included here, and also it is a investment in the new only new capital, yeah, new stocks, capital stocks. Now inventory, stock of unsold finished goods or semi-finished goods or raw material, which is from carry 1 year to the next, is called inventory. Or inventory is a stock variable, means the any firm or any uh, organization which stock or carry from 1 year to another year, or maybe it is unsold finished goods, semi-finished goods, or raw material, that is called a inventory, or it is also a stock variables. Inventory investment means inventory stock at the end of year minus inventory stock at beginning of the year is called a inventory investment. Another word, it is also called a change in stock, closing stock minus a opening stock. Any stock which is end of the years and which is opening of the years, that difference is called a change in stock. Like for example, if we want to calculate the inventory investment or maybe change in stock during 2019 and 20. So first of all, 2019 it was the opening stock, and 31st March of 2020 is the closing stock. The difference is called a change in a stock. It means inventory investment during that particular period, the particular years. Now, the next concept is the depreciation, consumption of fixed capital. Consumption of fixed capital or a depreciation refer to loss in the value of fixed assets due to the normal wear and tear or maybe accidental damage or expected or foreseen obsolescence. It is expected, refer to loss of value. The normal wear and tear of the assets. When we purchase any assets, then it is the value of that asset will be decreased normally. So that is called a depreciation. Normal wear and tear may be accidental damage or expected or foreseen obsolescence. Both that all are a part of the depreciation or a consumption of a fixed capital due to the use of that assets, and the value of that decrease normally, that is called a depreciation. In against of this is a capital loss. Capital loss is not expected loss in the value of fixed assets due to unexpected or unforeseen. That is called a sudden destruction or capital loss asset due to natural calamity, earthquake, flood, fire, accident, etc. That is called a capital loss. Means depreciation is expected. We know that if we purchase uh, any assets like 10,000 in present time, it will be the value of that assets will be reduced due to the normal wear and tears or maybe uh, the use of that assets. But capital losses against of the depreciation, it is unexpected. Means we will not expect that the value of that assets decrease due to the natural calamity, maybe earthquake, flood, or fire, or maybe due to the any other reason. But unexpected, the value of assets decrease is called a capital loss. So depreciation and capital loss. Sometimes they can ask the difference between depreciation and capital loss. So depreciation is normal wear and tears, and capital loss is the unexpected or unforeseen or sudden destruction of capital assets. Now, if we then current replacement cost, depreciation at the level of economy, that is called a current replacement cost. Depreciation reserve fund, the fund which the producer keep for meeting the depreciation loss is called a depreciation reserve fund. Depreciation at the level of the economy in particular current year, that is called a current replacement cost. Or depreciation reserve fund, against of this loss, if producers keep for some fund to meeting that depreciation loss is called a depreciation reserve fund. Now stock and flow. Stock is the variable which measure at a particular point of a time. That means stock is in not time dimensionals. It is measure at a point of time, not a period of time. In against of this, flow is the variable which measure at a particular period of time. It is time dimensionals, means it measure at a per hour, per week, per month, etc. So stock is the variable which measures at a particular point of time. Means like for example, if water reserve in a tank, that is a stock, because that we can measure at particular point of time. We can say that 10-liter water reserve in the tank, but the water coming from the tap, leakage of water from overhead tank, that is a flow. We cannot say at 5 o'clock the this much water leaked from the tank. So flow is the variable which we measure at period of time, but we can say that in and this 1 hour, 2 hour, half hour, this much waters will be leaked from the tank. So in this way, the stock is a variable which measure at particular point of time, but flow is the variable which measure at a particular period of time. Stock is not time dimensional. It measure a point of time. It not measure in particular period. Flow is a time dimensional. It measure at per hour, per week, per uh, month, etc. For example, here example is given: capital inventories, wealth, quantity, supply of money in the country, bank deposit, water in our head tank, etc. The example of flow is investment or capital formation. We cannot say capital formation in particular date, but we can say the particular period, change in inventory during that particular year. Not we can say on 1st April that this much amount changed. So income, interest on capital, leakage of water from the overhead tank, etc. So these are the flow. Sometimes in the exam they can also ask the difference between stock and flow. So on the basis of definition, time dimensions, and the example, we can differentiate between stock and flow usually in 3 points. Then the another basic concept is the factor income. These concepts are most important to discuss the methods or maybe to calculate the national income. So factor income is the payment to factor of productions. It means it is earned by the factors. Or if we will render any services for production process, then we earn something that is a factor income like rent, interest, wages, and a profit. Rent is a reward of land. Interest is a reward of capital. Wages is a reward of services, labor, etc. And profit is reward of the entrepreneur. So in this way, any rendering services reward is the factor income. So the total of that factor is called a factor income. Against of this transfer income or payment, the which are made to the household enterprise without rendering any services, productive services are called a transfer payment. Like as a widow pensions, unemployment allowance, charity or grant, etc. These are one-sided or related transfer. It means without rendering any service that they provide or receive. So that type of income is called a transfer income. Factor income we will include in national income. Transfer income will not include in the national income because it is a one-side income. It will not contribute in the national income. Then double counting. Double counting means the estimate of the value of goods and services more than once. Like for example, the value of wheat and flour separately while estimating the value of bread. Means one time wheat purchased by the flour mill from the farmers, and then they sell the flour to the customers. So they add both time the value of wheat and flour separately. So that is a double counting. So for double to avoid that double counting, we use the value of only the final goods and services to calculate the national income. So double counting means estimate the value of goods and services more than once. So that is a double counting. And double counting is the problem for calculation of national income. If we will count more than once one item, then it will overvaluation of the national income. Now the most important basic concept is the domestic or economic territory. Uh, Domestic territory or economic territory, it is the area administered by the government within which persons, goods or capital circulate freely. It means all the area which is administered by a government within which person, goods, and capital circulate freely. It includes the political frontiers, in political boundary of the country, including territorial water, 12 nautical miles area of the sea, air, and space, which is under the control of the any administrative authority is called a domestic territory or part of the domestic territory. Embassies, consultant, military base of the country located abroad. Any embassy which is located in the another country that is part of the country. Like for example, Indian embassy situated in the America. So that is part of the Indian territory, Indian domestic territory, not a America. But if any, like for example, US embassy situated in India, so that is part of the US, not a India. So it means any embassy, consultant, military base of the country located abroad, that is part of our domestic territory, yeah, Indian domestic territory. So that is a part of the domestic territory. Ship, aircraft, etc., operated by the residents of the country between two or more countries, that is part of the domestic territory. Indian ship which is operated in the residence between by the two country between two or more country, that is part of the domestic territory. Fishing vessels, oil and natural gas rigs, etc., that is operated by the residents of country in international water or other area, or so that is also part of the economic territory. It means any Indian fishing vessels that operated by the residents of the country in the international water. So that is part of the domestic territory, which the country enjoy the exclusive right, means all the thing which have exclusive right of the country. So that is part of the domestic territory. The income earned by this domestic territory is called a domestic income. Mean domestic income or a NDP, a net domestic income, which is earned by the domestic, which is earned within a domestic territory of the country is called a domestic income. Mean all factor income earned within a domestic territory of a country is called a domestic income. So domestic income which is earned within a boundary. So the domestic income is related to the place. Means when we identify which is the item which will be included in the national income or not, or which will be included in the domestic income or not. So at that time we will uh, identify that the income which is earned within a domestic territory of a country is part of the domestic income. Mean domestic income is related to the place where it is earned. The against of this, the second concept is the normal residence. The residence, whether a person or institution, the persons who are live in a country and whose economic interest lies in that country. The persons who are living in more than 1 year in a country and whose economic interest lies in that country, that person is called a normal residence of the country. It means in normal residents of India include citizens of country who normally reside in the country and whose center of economic interest lies in the country. Center of economic interest means he is earning in the country and he is spending in the country. Sometimes maybe investment also include in that case earning, spending and invest in the country. So that person is a normal resident of India because his economic interest lies in that country. Citizen of other country who live in our country from more than 1 year, 1 or more year, and whose economic interest lies in that country. It is not related to the political citizens of the country, but the persons may be citizen of other country, but who's live more than 1 year in our country, and his whose economic interest lies in our country. So that is a normal residence of India or a normal residence of a country. But our persons living in another country more than 1 year, but he is not a normal residence of our country. So he is maybe non-residence Indian, but he is not a normal residence of the country. Citizen of our country working in international organization or foreign embassy located in our country. The persons who are working in international organization or in embassy located in our country, maybe that embassy is not part of our domestic territory, but that person is Indian because he is working in another country that is located in our country. So that is the normal residence of the country. And ambassadors for India in USA. The in embassy, if the Indian government appoints some ambassadors in every country. So the ambassador for India in US or maybe US, they are the normal residents of a country. Official diplomats and member of armed forces of our country posted in abroad as a normal residence. So normal as residents as the persons who are living in a country whose economic interest lies in that country. The income earned by the normal residents of a country during an accounting year is called a national income. Mean national income is related to the persons who earn that income. So the income earned by the normal residents of a country is a national income. Now some rated aggregate on the basis of these basic concepts. First of all, the value of output. When we calculate national income by uh, value-added method, product method, we need a value of output. Value of output means the market value of all goods and services produced by an enterprise during an accounting year. Means when we calculate national income, first we need a value of all goods and services produced by an enterprise during an accounting year. So the total of this is called a value of output. How to calculate that value of output? Value of output is equal to sales plus change in stock. In sales, we can calculate price into output. The total output in a country into price. The total sale in a country plus change in stock. The total of is called a value of output. The second is gross domestic product at market price, GDP at MP. GDP at MP is the market value of all final goods and services produced by all producing units located in domestic territory of the country during an accounting year. It is a domestic income, a domestic product, so it is related to the domestic territory. It means it is related to the place. Mean all the final goods, because only the value of final goods we will include, not the intermediate goods. So the value of all final goods and services produced by the producing unit located in the domestic territory of a country during an accounting year is called a gross domestic product at a market price. Here two things are most important. One is the final goods. The value of final goods we will include only. Second is it is a domestic, so it is related to the domestic territory of a country. The income or the production which is produced within a domestic territory of a country is called a domestic income or domestic product. Now, how to calculate? Because value of output we calculate on the basis of that sales plus change in stock. When we want to calculate gross domestic product at market price, then we need the final goods only, because in value of output we are taking only the goods, not final or intermediate. So the value of output minus intermediate goods is a gross domestic product at a market price. If we will reduce intermediate goods from the total output, that the remaining is a gross domestic product at a market price. Now the next concept is the net value, the net domestic product at market price. So domestic product at market price already we have calculated. If we reduce the depreciations from the gross, the remaining is a net domestic product at a market price. It's a net value of all final goods and services produced by all producing units located in the domestic territory of a country during an accounting year. Now the national, gross national income or gross national product at market price. It is the total of all factor income which is earned by normal residents of a country during an accounting year in the form of wages, rent, interest, and profit. That is called a gross national product. Now here, the one another most important thing is there. Final goods is there, but it is related to the normal residence of a country. It is not related to the domestic territory of a country, but it is related to the normal residence of a country during an accounting year in the form of wage, rent, interest, and profit. So when we calculate GDP, then how to calculate gross national income from that? So GNP at MP equal to GDP, gross domestic product market price, plus net factor income from abroad. Now the question arises here, what is net factor income from abroad? So net factor income from abroad is the income which is earned by the foreigners in our country and the income earned by the Indian in the another country. The difference is called a net factor income from abroad. The factor income from abroad means our people are working in another country, they earn some income, and the another country people, the rest of the world people, they are working in our country, they are also earning income. So the difference of that from abroad minus to abroad, the total remaining is a net factor income from abroad. Maybe it is positive or negative, depend on the income from abroad and to abroad. Domestic income, when we calculate, then we calculate only within the domestic territory of a country, may be earned by the normal residents of a country or may be earned by the foreigners. So if we want to calculate in gross national income, gross national income is related to the normal residents of a country. Here, national income is related to the persons. It means the Indian persons. So domestic income is related to the place. If we will add net factor income from abroad in the domestic income, the remaining total is a gross national product at a market price. If net factor income from abroad is negative, then we can reduce. So the gross national product at market price is equal to gross domestic product plus net factor income from abroad. Now the net we can calculate here NNP at MP, net domestic product at market price plus net factor income from abroad. We can calculate another way is also there, gross national product at market price minus depreciation. In any way we can calculate. Now the next and the concept is the national income or NNP at FC. This we are calculating on the market price, and here the factor cost. What is the difference between market and price and factor cost? In market price, all indirect tax are included and subsidy are subtracted from there. But that is on a market price. When we purchase goods from the market, it means the tax is included in that. So factor cost, it means the cost of the factors only. So market price we calculate already. If we want to calculate on the factor cost, then NNP at MP minus net indirect tax. Net NNP at MP that already we have calculated. If we will reduce net indirect tax, means indirect tax and subsidy, the difference is called a net indirect tax. The remaining is a national income or NNP at FC. NNP at FC is equal to national income. NDP at FC is equal to domestic income. In the same way, we can also calculate NDP at FC. NDP MP is calculated already. We have calculated. If we will reduce net indirect tax from that, then the remaining is a net domestic product at a factor cost. Net domestic product factor cost is the domestic income, and net national product at factor cost is the national income. So in this way, we can calculate the national income. Now, the another concept is the nominal or real GDP. Nominal GDP, the value of all goods and services produced in an economy during an accounting year on the basis of current year prices. We have two types of prices, current year prices and base year prices. Current year prices mean in which year we want to calculate the national income. Base year prices is the previous year, any previous year, or which is decided by the government or authority. So GDP at current price means the value of all final goods and services produced in an economy during an accounting year on the basis of the current year price is called a GDP at current year prices or a nominal GDP. GDP at constant price, this is called a real GDP. If we calculate value of all final goods and services on the basis of the base year prices is called a real GDP. Real GDP is calculated on the basis of the base year prices. Nominal GDP is calculated on the basis of the current year prices. The another concept is the GDP deflator. GDP deflator is the ratio of nominal GDP to the real GDP multiplied by 100. This we can calculate by a formula. And GDP deflator is nominal GDP upon real GDP into 100. Now, another concept is there the externality or the GDP and welfares. The externality refer to the benefit or harm of activity causes by a firm or individual for which they are not paid or penalized. It means the due to the another activity for that we are not paying or not penalized if we affected, so that is a externality may be the positive or negative. Sometimes we get a good benefit and sometimes maybe that activity harm us, so that type of activity is called a externality. It may be positive or a negative. For example, environmental pollution caused by industrial plant is a negative externality, and building a flyover is a positive externality. If government construct building or a bridge, that is a positive externality for the people. But if any plant that exploit the peoples, that harm the health of the peoples, maybe affect the health of the people, so that is a negative externality. So any type of activity which is caused for an individual without paying or without penalized, so that is an externality. Thank you. Methods we will discuss in the next session.